return from the close of 2018. I think we're slightly higher than consensus forecast of about 8,400. So 8,600 is a bottom-up approach, meaning all the PSE constituents, the 30 names, we looked at it, projected a target price, and this is the result, 8,600. And at this level, it implies a price to earnings of about 18 times, and earnings growth of about 11.7%. So it's a bit healthy, it's realistic. We expect probably if earnings overshoot by more than 12%, then the price to earnings would even be lower. So it means that the market will become cheaper. And I think the Philippine market deserves to trade at a premium, given the fact that there's more earnings visibility here, given that 75% of our GDP is consumption driven. So you can see that a lot of the companies that are more on the consumption side will definitely be able to contribute to the earnings growth. So there's still a huge upside from where we are right now. I think as of today, we're at about 7.7s, below 7,800. So there's still a hefty return for investors from where the market is at the moment. So there's been just some, of course, it does not go up in a straight line. Although we are quite bullish in the market, we may expect volatility down the road, given the fact that there's a lot of negative sentiment towards the US-China trade war. There's that momentary MSCI rebalancing that would add weight add more weight to China, thereby reducing weight for the other constituents of that MSCI index, which unfortunately the Philippines is part of that index. So we expect some outflows of estimated from about 100 to about 200 million US over the next few months. It starts by end of this month. Then next would be September and then November. But again, these are just passive outflows, which as an investor can be used as a perfect timing to load up for equity funds, given the fact that we are poised to grow at a much higher pace from where we were last year, where the market was riddled with a lot of macroeconomic challenges. This year, inflation is tame. Elections are over us. There's no more overhang on midterm elections. The economy is poised to grow. There's been more pronouncements by the government of major infrastructure projects that are about to break ground, that has broken ground already. Interest rate environment continues to be supportive of equities, both globally and domestically. So definitely we have been seeing more inflows, in fact, on the Philippines. And we are not really a victim to that US-China trade war. And in fact, might be an advantage for us because we don't directly trade with those two, and there's no manufacturing here for that. So we have been seeing some channeling of manufacturing to the Philippines because of that problem with China and the US. So definitely a lot of positives moving towards the country and is supportive of growth. So both equities and fixed income, lower rates, potential for higher equity markets, then definitely financial markets would be a lot better for 2019 and moving forward. So in summary, inflation, I think it's already something not to be worried about. and it paves the way for more rate cuts. We see 3 more BSP cuts for this year as inflation continues to tame. So from the 4.75 policy rate last year, we might have the possibility of seeing it below 4% by the end of the year. The reserve requirement, again, this has been announced by the BSP governor several times that he will accelerate the RRR cut. So we have seen 200 basis points. We probably see more towards the end of the year, as probably they would have to time it first and see how the economy can absorb it, this additional liquidity, before they start cutting the reserves again. The 10-year rate, we can see it closer to 5%. Right now it's about 5.7. Probably expected to see break 5.5 soon, then towards 5%. The US 10-year rate, we expect it to be about 2.5 to 2.6%. So it's still within the range where it is at the moment. We don't expect it to move up above 3%, thereby disrupting markets again.